Good morning. You're watching a live market outlook for Thursday, 19th of January 2012, prepared by Windsor Brokers. Another day of positive action of euro as it extends gains, starting the day in the positive tone and extending gains to test one of the key barriers at 128.77, followed by commodities and commodity currencies. The support was also given by the overnight news that IMF wanted to bolster its war chest to help tackle the Eurozone debt crisis, short up risk sentiment during the Asian session. Basically, the IMF is seeking to more than double its war chest by raising 600 billion in new resources to help countries deal with the fallout of the Eurozone debt crisis. But the plan faces roadblocks from United States and some other countries. The US and Canada said yesterday Europe must put up more of its own money to resolve its sovereign debt crisis, raising doubts G20 talks in Mexico this week can lay the ground for a deal of on bolstering IMF resources. Japan and South Korea also want Europe to do more, and China might insist in a number of conditions are met before it supports a boost in IMF resources. A group of 20 deputy officials meet in Mexico City today and tomorrow to discuss boosting IMF resources. Any outcome would need the leaders sign off, and the next G20 finance ministers is in late February. The IMF plan to boost its lending capacity eased worries on financial markets about Europe's funding difficulties and boosting the value of the single currency. IMF sources said the world faces a $1 trillion financing gap over the next 2 years if global economic conditions worsen considerably. Also, the IMF current lending capacity is about 380 billion US dollars. From Greece, they began a new round of bargaining on a bond swap deal with its creditors yesterday, with both sides under mounting pressure to iron out differences before they push Athens to a messy default. The two sides said little after the more than 2-hour meeting yesterday, other than to note that they would meet again today, and Greece needs a deal within days to avoid the prospect of default when bond redemptions come out due in March. Officials and bankers earlier expressed hope that a deal could be struck in coming days, despite a breakdown in talks last week over the interest rate Greece will offer on new bonds and the plan to enforce investor losses. Both points were on the table when negotiations resumed between International Institute of Finance that represents the private creditors and the Greece Prime Minister and the Finance Minister. So some positive tone, as we can see, is currently existing in the markets, with hopes that things will be handled in a proper way to likely avoid the disastrous scenario that is still hanging above Europe's head, as the crisis shows no sign of any improvement for now. Back to today's events, brief look on the calendar already released, showing Australian unemployment rate dropping to 5, basically coming at the same level the previous month at 5.2, despite higher expectation at 5.3, with the employment change dropping to 29.3 thousand versus the minus 7.5 thousand the previous month release. UK's nationwide consumer confidence release during the night shows the result of 38, weaker than 41 expected and 40 the previous month release. From China, CB leading index came out in a positive figure 0.5% compared to minus 0.1 on previous month release. Still to come in approximately 45 minutes at 9 GMT is European current account with improvement of €500 million expected compared to the gap of €7.5 billion in the previous month release. This would be all from Europe. From Americas, US building permits are due at 13:30 GMT, and unexpected and unchanged the expectation for today 0.68 million permits compared to the same figure of the previous month. US CPI monthly is expected to grow by 0.1% compared to previous month unchanged, while core CPI monthly is forecasted at 0.1% versus 0.2% previous month. US jobless claims, the key event of the day, are expected to drop by 387,000 compared to 399,000 the previous week release, with the Philly Fed Manufacturing Index due at 1500 GMT, expected at 10.7, better than the previous month at 10.3. US crude oil inventories, weekly inventories that were moved to today from yesterday due to the Martin Luther King holiday on Monday, are expected to grow by 2.9 million barrels compared to the build of 5 million barrels in the last week release, and this would be the fourth consecutive week of building up the crude oil stocks in America, if today's release will be according to expectation or even higher. Now let's take a look on the technical part to see the latest movements in the markets. As we can see, the euro is in steady uptrend from last Friday's low at 126.22. That was briefly interrupted 2 days ago by a strong pullback where the support, when the support was found just above 127 mark. The latest rally has fully retraced the recent downleg from 128.77 to 126.22, testing exactly 128.77 in the early hours of today, and keeping potential for further extension higher as the studies remain in the positive field. However, overbought conditions might see some corrective pullback preceding a fresh rally. 128 zone offers strong static support, and 20 days moving average on 4-hour chart at 127.55 currently is maintaining current move, with the trend line support currently standing at 128. Ideally, reversal at above 128 would keep the current near-term bulls in play for a possible extension higher. Break above 128.77 faces the next level of 129, which marks a 61.8 Fibonacci retracement of the move from 130.71 to 126.22, above which to confirm the near-term bottom and the open way towards 130.71 on the break. On the downside, risk is seen on the loss of 128, 127.50 that might risk double top and further extension lower, as the daily studies are still bearish and yet showing no signs of recovery. Current attempt at 20 days moving average on the daily chart might be significant in case of a break higher. That might ease the bear pressure on the daily chart and look for a stronger correction. But overall, the trend of euro-dollar remains firmly bearish. The cable has extended gains after initially being congested under 154. That was the key near-term resistance. Two attempts higher were unsuccessful as 38.2 Fibonacci retracement of 156.68 to 152.33 kept the upside limited for a couple of days. Yesterday's strong rally through 38.2 Fibonacci retracement at 154 zone has so far extended to 154.45, just ahead of 154.50, 50% Fibonacci retracement, keeping scope for a further extension higher. Again, near-term studies are in overbought territory and looking for correction before the fresh rally resumes the current recovery from 152.33 with initial support, previous resistance at 154 zone now offering support, and ideally reversal around this zone would be the best to resume the current recovery. Mind that why the picture outlook is still bearish, especially in light that the pair lost some of its key levels, the longer term range floor at 153.60, 153, and the immediate risk is seen on further extension lower with next target at 150 zone seen in the short term. On the upside, regain of 155, which is a key short term barrier, would prevent a further fall in the short term and allow for a stronger recovery towards levels at 156, 156.68, which is 3rd of January high of 2012. Failure under 155 would be risking a lower top and fresh extension lower. Dollar yen currently moving in a narrow range, directionless mode after attempt to at key support at 76.50 zone was contained at 76.54, with the pair now moving sideways within the range of 76.67, approximately 20 pips range. Studies on the near term 1 and 4 hours are rather neutral with the break above initial resistance at 76.85 and more significant 77 level required to define the direction towards the upside, while loss of 76.50, our key support, would resume the broader downtrend, and at this point this would be more likely as the broader picture still keeps the negative tone as 90 days moving average capping the upside, and the recent dead cross of 20 days crossing below 90 days moving average keeping the downside more under pressure. Loss of 76.50 to open 76.10.00 and possible extension down to pre-intervention record low at 75.56. Only break above 77.20, 77.32 high of 6th of January would provide near-term relief and avert the immediate risk of breaking below 76.50 and open way for a stronger recovery, where we have array of resistances at 78 zone, the stronger resistance zone at 78, 78.20, 78.27, and above this 78.47, 200 days moving average. Dollar Swiss at the back foot after unsuccessful several attempts to regain 96, our key barrier, and resume the broader uptrend. 95.73 double top was seen before the pair resumed lower, accelerating losses on loss of 95. Static and dynamic support were also there. 20 days moving average was lost. and breaking below 94. That was our key near-term support. Lows of 13th and 12th of January. 93.78 low was seen so far, with some corrective action expected on the oversold conditions. However, the near-term outlook remains negative and keeps the downside favored. Possibility of further extension higher after ending of corrective bounce, with the 94.50, 94.75 zone expected to cap the bounce higher, and the extension towards 93 zone is quite likely. This is 55 previous low of 3rd of January, 55 days moving average, as well as daily Bollinger Band, the lower daily Bollinger Band that marks a strong support, a loss of which would weaken the broader structure and uptrend, strong uptrend from a 70.67 record low of dollar Swiss and 2011 low, and we'll put the bulls aside in favor of a stronger correction. Gold and crude oil remain well supported. First, we're going to see the yellow metal as it stays well supported by 20 days moving average on the 4-hour chart, with the latest rally attempting at the previous high posted on 17th of January at 1667. On the wider picture, we can see that recovery is picking up after a break above 200 days moving average, currently standing at 1640, with next strong barriers at 1666, 1667, the break point actually here, to open way for a next dynamic resistances 1676 and 1683 are 55 and 90 days moving averages on the daily chart, ahead of main bear trend line at 1685, above which to attract levels at 1700 and 1756, 1763 highs of beginning of December. That would confirm the bottom at 1522 and allow for stronger recovery. Also would change the attempt to change the short-term downtrend from basically medium-term downtrend from September 2011 record high of gold at 1920.92, and look for a further recovery. As seen on the weekly chart, the uptrend is still in a way intact, as long as levels at 15 and slightly below 1500 hold the downside, but recent downtrend is still in play, as long as the trend line from 1920 and 1700 barrier stays intact. The crude oil is continues to trend higher after leaving a higher low at 99.100. This was what was mentioned in the previous two sessions, yesterday and then before, as 100 support is our key as well as psychological level, with the oil attempting at levels above 102, 101.76 was seen so far. The studies remain supportive on 1 and 4 hour, as 20 days moving average currently at 100.66 maintains the recent rally after breaking above the moving average at 121. Focus on the upside is 102, 102.22 ahead of 103, a regain of which is recovered to confirm the higher low at 97.92 and attract levels above 103, which is 103.39 and 103.72. On the downside, initial support stands at around 100.60 ahead of 100, which is our key support, loss of which would be risky at this point and would risk stronger reversal